Welcome back. Now, oil prices were close to their lowest levels this year today, with soaring U.S. output undermining OPEC's efforts to tighten markets and prop up prices. Brent crude futures were at $65.28 per barrel, down 23 cents from the previous close. U.S. West Texas Intermediate crude futures were at $61.58 a barrel. That was down 21 cents from their last settlement. The dips follow bigger falls on Wednesday when crude touched one-month lows and erased most of 2018's early gains. Some support on Thursday came from the second outage in as many months on the 450,000 barrels per day Forties pipeline network, Britain's biggest, which supplies much of the crude underpinning Brent futures. And there seemed to be a lot of uncertainty around oil price this year, and analysts see stable demand growth and continued rebalancing of the market this year. Let's discuss more with Desola Simone, research analyst with Financial Derivatives Company, joining us from New York City. Hello, Desola. Thank you very much for coming through to us.
Hi, Chimeze. Good morning. Thank you
So we've seen Brent crude and volatile trend this week declining by 2.4% to hit a one-month low of about $65 per barrel. U.S. production has been the biggest market driver. What are the other factors driving this steep decline at this point?
Apart from the spillover effect from the volatility in the U.S. stock market, we've also seen, like you rightly said, that U.S. crude oil production, according to the EIA, increased by 332,000 barrels last week, bringing the total production to 10.25 million barrels per day, which is now the second highest producer in the world. So the U.S. production, we also have the U.S. crude stockpiles. The data from EIA also showed that the U.S. crude stockpiles increased by 1.9 million barrels a day. This was contrary to an earlier industry report, which showed that the crude stockpiles actually declined by 1.1 million barrels. So in addition to all these factors, we also have the U.S. dollar, the stronger U.S. dollar, which has gained 0.99% week to date against a basket of 6 currencies. Now, in addition to all these factors, we also have the U.S. rig count, which increased by 6 rigs in the week ended February 2nd to about 765. And all these factors put together are weighing on the price of oil in the global commodities market.
Now, aside from oil, which agricultural commodities were affected by the volatility in the U.S. stock market?
The volatility in the stock market, it affected base metals such as copper and iron ore. And we also saw safe assets such as gold increase. But for the commodities, agri-commodities, we didn't really see any impact on that because usually agri-commodities prices are not affected by financial market volatility. Rather, they're affected by weather-related shocks, which affects the harvest, and also they're affected by stockpiles. So the volatility in the U.S. stock market had little or no impact at all on the agricultural commodity prices.
Now, do you think the sharp decline in oil prices is likely to persist in the near term?
No, I don't think so. I think that, again, that this is just a short-term phenomenon. I think, that commodity prices are actually volatile, and it's not uncommon to see these kinds of volatility because, if you look at the market fundamentals are still very strong. The compliance with the OPEC-led production cuts is still very, very high. So the market fundamentals are still very good. Also, historically, commodities perform very well during rate hiking cycles. So, and we know that the U.S. Fed is about to embark on a rate hiking cycle this year. So with that, I think that the commodity markets are still good, the fundamentals are still good. And I also think that this volatility is just short-term volatility.
Now, talking about OPEC, looking at the trend in the global markets now, what do you think will be in the minds of the OPEC members at this time?
The sharp rise in the U.S. oil production is a cause of concern for OPEC, and I don't think that they're going to call off the agreements anytime soon. I think they're going to extend it at least to the end of the year to see how how the U.S. production is going to affect the global inventories. Also, yeah, so yes, that's what I think.
And if this trend continues, how will it affect Nigeria?
Well, if it is not, like I said earlier, it is not likely to persist in the near term. But if it does, then we are going to see it affect our export revenues, and it may constrain the ability of the central bank to continue to inject fresh dollars into the FX market. So that's the way I think that would affect Nigeria. But I do not think that this volatility is going to persist. I think it's just a short-term phenomenon, and it should be over in a couple of days.
And what's your general outlook for the oil markets in the near term?
Well, given the volatility in the global financial markets and the oil markets, it should not be surprising to see oil decline as low as $60 per barrel. But I think that it should not decline below that. I think that it should trade between the range of $60 to $65 per barrel in the near term.
All right, thank you very much, Desola, for your time. Enjoy the rest of the day out there in the U.S. Thank you, Desola. Desola Simoni is one of the research analysts with Financial Derivatives Company. We'll move on now. African miner Petra Diamonds is likely to strike a deal with its lenders that could include a waiver or a reset of its debt covenants within the next month. The London-listed mining company said last week it had started negotiations with its lenders for debt agreements relating to its EBITDA for December 2017 and June 2018. The confiscation of a consignment of its diamonds in Tanzania and a labor strike at its South African mines were the main reasons that Petra flagged in October that it was likely to fall short of its loan obligations. Petra, which operates 5 mines in South Africa and Tanzania, reached peak capital expenditure in its last financial half year after 7 years of investing more cash than it generated into expanding its operations. And finally, the metal markets, gold prices dropped today for a third consecutive day, holding near 4-week lows hit in the previous session on a firmer greenback aimed at expectations of more U.S. interest rate hikes this year. Spot gold was down 0.4% to $1,313 per ounce in the previous session. It hits its lowest since January 10. U.S. gold futures for April delivery rose 0.1% to $1,315 per ounce. The U.S. dollar rose on Wednesday, marking its biggest one-day gain in more than 3 months against a basket of currencies. It was steady at 90.216 today. Among other precious metals, silver edged 0.4% lower at $16.31 per ounce. In the previous session, it touched $16.26, its lowest since December 22. Platinum declined 0.8% to $972 per ounce after touching its lowest since January 11 on Wednesday. Palladium fell 0.4% to $980 per ounce. In the previous session, it hit $978 an ounce, its lowest since November 15. And that's it on today's show. Thank you very much for watching. I'm Chimezi Obi Iwagu.